Good morning, SMF Street. At 9:47 a.m. It's been one good trading day. Prices came straight down because we're so overbought. But let me show you here. This is the SPY. It's back up. It hit 113.18 and bounced off the bottom. And that's the SPY. That's a ETF. And this chart up here is the actual S&P 500 index. This is related to that index, but it's the ETF, and it bounced well off the bottoms. But let me show you something more important. At that $1,150 put on the S&P, the S&P closed at 23. Today's low was 21.50, which was done a minute ago, but you ran straight up to $29 during that heavy morning sell-off in the S&P. Then the S&P came down in its volatility along with the spiders and hit that bottom and bounced off of there like a rocket, like it should. What you want to see is that these people here are paying 1,900 contracts times $22. Here, let me add that one up for you. Basically, I just added that up, and it's $418,000 buying that 1,900 contracts. Again, the big money keeps moving back in. Yes, it's volatility. Yes, that's a daily reversal. Yes, we have lots of slide to bids, but they were buying these contracts before at the 1100 call really big, as you can see on our site. So the total volume today is 7,170. The time is 9:49 a.m. Pacific Standard Time. Markets have only been open almost 9:30, so 3 hours and 20 minutes. The heavy buying started coming in at 12:36 Eastern Time here on 1,000 contracts. 12:47, another 1,000 came into play. At 12:29 Eastern Standard Time, 1,900. Then you've got 200, 200, 400, 500, 600, 900 in there. You got these 300 contracts. Well, 300 times $22, you do the math. Now, the thing about it is, we've been covering this $1,150 put, SMF Pro MMT index traders that you are. And the thing about it is, it's because of your patience is that we got bids, and we're going to put bids below the market for the volatility. And basically what we're going to do here is that we see that was at $29 on the high, $21.50 on the low, $21.30 by 23 on the bid and ask, and they're buying big. Now, SMF has not bought the contract yet because we're making sure that the volatility from the bottom up and the volatility from the top down is measured perfectly. Now, watch me give the glory of this bid, and I'm going to give the glory of this bid at $16.50. And I'm going to put that limit order out. I'm going to put that limit order out right now. And we're going to start scaling down here on the lower entry side. Then we're going to go check and make sure we have it open. Well, somehow it didn't take. Let's cancel all. Here, let's put CBO. Let's put $16.50. $16.50 in the volatility band. Actually, we'll take it up to $16.70. Let's not change our $16.70. We'll keep it at $16.80. Buy 3. So here, it's giving me a buy. Okay. But once again, it's telling me I'm way away from the market. So what? The cost is $5,000 on 3 contracts at $16.80. Let me tell you something. If you would have bought 3 contracts today, thinking the markets weren't going to bounce off those lows, it would have been that there would have been $9,000 versus $5,000. I am getting down here at that cost. If I bought 3 contracts or 10 contracts at $29,000, and I'm buying 10 contracts, I end up getting $16,800. I'm saving that, and these contracts are already deflated. So I'm going to hit OK. I'm going to move this out of the way. What I am going to show you is that market volatility starts at market tops when you get the very extreme movements that we had today. And they always start with the test of these daily moving averages bouncing off that bottom, and that spider, which is related to it's an ETF, but it's still related to the S&P 500, had a nice move off those lows. And that's how that bottom-up volatility, the top-down volatility has been happening. And today is the 5th actual trading day. It started last week. And we have all of those on the stockmarketfunding.com website or dailystockcharts.com. You can go there, see new from oldest. And we've been showing how prices and how they slide that bid. Just before we leave, we just had another big round, 100, 200, 300, 400, 500, 600 more coming in here at $22 a contract. That was that last print. So once again, people are really betting on, the bigger people are betting on a huge crash. Well, after that kind of selling today, when we've seen stocks like Google dropping $13, $14, $15 off the intraday high, and we watched the whole tech sector, we watched the bear and everything else do what it did, well, hey, this is the classical part of how they're put in. Okay? So basically, between that bear and that bull fight, this is how things go. Now, if you're a true MMT trader that trades the S&P 500, you would know that I've been pricing these a lot lower below the market. And I've got all the live training videos with our MMTs. They can go back and see this particular one. I mean, we've got the whole chain that we did, and that whole chain just so happened to be various different calls we had, puts that we're looking at. If it went up to 1175, we priced these well below the market. The 1190 call, if it wanted to go higher. There's all kinds of strategies. Once again, we've already done them. MMTs know the pricing level. That's the spider. That's the S&P 500. These are the S&P 500 1150 index put options. And once again, the master of that wholesale print, meaning that we're looking at getting well below the market here at 1680 and then adding accordingly in the volatility band.